Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Friday, May the 9th, 2025. It's about 7:30 as I'm recording this in the morning. Okay, so clearly, the big news sort of from yesterday was sort of news on tariffs. There was a so-called sort of deal announced between the United States and Britain, Great Britain, the United Kingdom. Trump, of course, and his and Lutnick and Besant and his cronies essentially tried to depict this as a breakthrough deal, as something fantastic. But what the market has done, and myself, we're just sort of analyzing the details a little bit, is that at the end of the day, a couple of key things stand out that. It looks as though there's going to be a 10% absolute minimum sort of universally on all tariffs. And that's what's happening on the UK, for example, for cars. There was some talk that, Trump said they reduced tariffs on incoming cars, but essentially it's only 100,000 cars, luxury cars. So I don't know how much of good news that is or interesting news. And as Lutnick himself said, countries like South Korea, Japan, and obviously China are much bigger economies, much more complex. And he said these deals are going to take weeks, if not months, to complete and will be more complex. So that's even Lutnick himself, who was the architect of yesterday's agreement with the UK, basically saying that almost, admitting that the UK was the easiest one because there wasn't a huge trade surplus. There was strong sort of historical linguistic ties. So I think the point is that the market initially it is true that the market is trading with a bit of a risk on sort of feeling, and we can look at that. We can look at a few different assets here, but there's still a lot of nervousness, and of course, a lot of it will also depend what happens this weekend in Switzerland. We have Secretary of State, no, Secretary of Treasury, Besant, who's meeting with a Chinese representative, and again, the expectations for that by Besant and the Chinese are quite low. I was just looking just this morning at just a few developments from China. And it's just interesting. You think about the rhetoric going in here. This is the Vice Foreign Minister, Hua, who said, and this is a quote, "China has full confidence in its ability to manage the trade war." So not backing down at all. Secondly, another quote from a Vice Foreign Minister, so it's official, is China has no fear if we have to face up to the reality of trade talks. So China has no fear about the reality of trade talks. So of course, this could be, aggressive posturing before they actually start talking. Absolutely. But I think the Chinese are trying to signal to the Americans that, they're not the UK, they're not a small country. They want to be treated with respect, and they will do what's best for them. The other thing which I think is symbolically kind of interesting is that yesterday there was another deal announced, this time between China and Argentina. About $900 million for soybeans and corn. So basically agricultural products. Now they were products which, China had been buying from the US, but sort of very symbolically, I think they basically said, no, thanks, America. We're now going to buy these sort of soybeans and corn from Argentina. So essentially signaling to the Americans that there are alternative markets available globally and that they're not going to be pushed around. So stepping back, looking at the details of what happened yesterday with the UK, the Chinese rhetoric, Lutnick's comments about, South Korea and Japan. It seems to me, and again, reading a bit of research, sort of yesterday and again this morning, that at a minimum, we seem to be looking at maybe some kind of overall rate of at least about 10 to 15 to 20% if you factor everything in. And just looking this morning, like Trump yesterday said something that, the 145% tariffs on China would probably come down because that's not really sustainable. But then again, this morning, as is his way, this is literally, 5 minutes ago, Trump says tariff on China is up to percent. And here's the key one. Trump says 80% tariff on China seems right. So 145% down to 80% tariff is still absolutely extraordinary and punitive and very, very disruptive for global trade. So all of that to say is that even though the market, we look at a few markets here. So for example, we can look at something like oil. Let's just have a look around a few markets here. There has definitely been a bit of a risk on tone. And we know that yesterday Trump did say to everyone, buy stocks now. Now, remember last time he said buy stocks, that was just a few hours before he sort of introduced this idea of the 90-day reprieve, this 90-day pause. So could we be getting some sort of big announcement, who knows, maybe on Sunday night or Monday morning from Trump that, tariffs on China are being slashed to 25% or something? It's possible. It's absolutely possible. But just for example, there is a bit of risk on. So for example, you look at oil here. Oil seems to have retested that double bottom here just for the moment. What's interesting here on the continuous contract is that it's just breaking above the first bit of resistance here, which is the 60 on the shorter term, the 61.8 fib retracement. So that's a positive sign. It's also breaking above, although just giving it back a little bit of the 20-day moving average here, you see. So first little bit of resistance here, but oil is signaling that maybe the global trade will not be a disaster. And as I keep on saying, the front of the curve is still in a backwardated state, so that's still indicating physical tightness. Global inventories, U.S. oil inventories are at quite a low level. I was looking at some numbers yesterday; they're at actually a pretty low level. The physical market is quite tight, and demand is still relatively robust. So a lot of the fear is about sort of projecting into the future. So at the moment. We know that the Saudis and OPEC Plus have increased their production. But on the other hand, there was also some talk yesterday from Trump about a potential new sanctions on Iran and their oil sort of production. So the point is that oil at this point has had a nice little bounce. We'll see if that's sustained. And again, it's going to be interesting watching this market because as we go into the meeting in Switzerland with Besant and the Chinese, if there's a lot of positivity, I think oil could definitely pop significantly higher, maybe retest up to some of these levels, 63.80, 63.90, $64 or so, even maybe up to the 50-day moving average. But if there's sort of coolness on the Chinese side, I mean, what I'm assuming is that Trump himself and Besant, after the meeting on the weekend, will probably try and pump things up and say, a wonderful meeting, very, very positive, things are looking great. The Chinese may be more circumspect, and I think that could dampen spirits. And if that is the case, then I absolutely could oil sort of, have a quick sort of move back down here. Absolutely, that's possible. But so far, so good for oil. If we look also at the dollar in general has had a relatively positive sort of week or 10 days. But as you can see here, not a huge amount of energy, as I was saying yesterday, just not a lot of energy here. It got just above this 100 level, which is a pretty key important level, this purple level, which is 100, just a little bit above the 20-day moving average. But as you guys can see here, not a huge amount of energy. Now, for sure, again, if the talks go well on Sunday, could there be a further pop? It's possible. But already we're seeing, things like the Japanese yen. Let's have a look at the yen. The yen already, it lost a bit of ground, but as we get to this 50-day moving average, you see the yen starting to gain strength as the US dollar goes down here a little bit. Something like the Aussie. Now, the Aussie is in a difficult situation here because that's very dependent on global trade sentiment. So the Aussie just sort of pretty flat at the moment, as is Canada a little bit. Canada lost ground a little bit to the US dollar, but again, that's trading quite closely with the US dollar. Talking about Canada, there is employment data this morning at 8:30, so in about an hour or so from Canada. And again, we had Macklem from the Bank of Canada yesterday coming out with some fairly downbeat, sort of pessimistic sort of comments, essentially saying, that the trade war was ongoing, that could damage Canada's economy. So sort of fairly sort of negative, pessimistic sort of overview about the future of Canadian economy or the risks to the Canadian economy. So it's going to be interesting to see here if CAD finds further strength and the US dollar goes down, or whether this just trades in a bit of a range here around this pretty key level. You can see this 138.50 level here is a very key level. And of course, the employment numbers this morning might give a little bit of direction one way or the other. Let's keep an eye on that. Just finally on the currencies here, you see the euro, as I was saying, like sort of a week or two ago, it's just having a bit of a consolidation here. Now, is this going to be some kind of bull flag? It's getting to a pretty key level here around about, 112 or so, showing a little bit of strength this morning. But again, I think we want to see just what happens with US economic data, European economic data, and of course, a little bit more clarity about the potentiality of some kind of trade deal with China. But again, I keep on wanting to say, and this is going to be absolutely fundamental, even a so-called deal with China is most probably going to represent, 10, 15, 20, 25% sort of tariffs going in the medium term, which can't be good. So the question really is, what kind of time frame does the market want to operate on? So let's keep an eye out there. The other interesting thing, which I read this morning, Which just sort of got me thinking was this idea that shipments from China, they basically peaked about 3 or 4 weeks ago, and shipments since then have gone way down because no one wants to pay the or is able to pay the 145% punitive tariffs. So it could be an interesting situation just in terms of the domestic politics in the US. Is in another few weeks, if we start to see a situation of shelves being bare, like no products in the supermarket or less products in the supermarkets, and also just in general the supply chain in sort of small and medium businesses into the US just starting to really feel a bit of pressure because there's no more parts coming in and no more, sort of everything, right? Like, objects and sort of stuff coming into the US. And could that start to ramp up the pressure, not on China, but actually back onto Trump and the American administration, as maybe we start to see the supply chain breaking down in some form in small and medium businesses, maybe even in the context of, Walmart or supermarkets where there's just like less stuff on the shelves coming in from China. So that's something interesting to look out for. Probably it's not a story for today. Maybe it's a story for the next, 2, 3, 4, 5 weeks. As I say, where these lack of shipments coming from China starts to make themselves felt. Also, just looking at in terms of the risk assets, we're seeing here, if we look at the yields, what is kind of interesting is that we saw a big jump in the yields over the last 2 or 3 days at the front end of the curve. And we can look there, and that was basically because of Powell, on Wednesday was, relatively hawkish and essentially said, labor market's fine, economy is fine, super nervous about, stagflation going forward. And I just wonder whether Powell was particularly a little bit on the sort of aggressively, sort of semi-hawkish side, just to really try and send a message to Trump in the White House that the Fed was an independent sort of entity, and that they certainly wouldn't be seen to be caving to pressure for to reduce interest rates. But just the way we can sort of look at that again, I'd just like to keep an eye on the SOFR curve. Just grab some coffee, some tea. Some Lady Grey this morning. So what we can see is that the live data is the white line here. So this is every 3 months represents, the 3 month SOFR contracts. So it's kind of interesting here that you can see where overall all across the curve, and this is 1 week ago, is the blue line. So this is compared to 1 week ago. So you can see all across the curve, even from basically now and the very short term, going all the way out to the end of 2026 here, you can see that the curve is repriced higher. So a higher implied yield, which is a bit more hawkish, basically saying the Fed will cut a little less. And you can see that here that if you look at December of this year, we were at 4 cuts, so now down to 2.7. But the point I'm trying to make, which I made yesterday, or I think, or the other day, is it's just kind of interesting to see where a lot of the changes have happened. Really, a lot of the changes here have happened around, let's call it, the September, October, December of 2025. So really what the market here is trying to say is like, hey, we don't need the cuts as soon. But 2026, as you can see here on the right-hand side, less dramatic change. So essentially, hawkishly repriced in 2026, but much more so for the next, let's say, 5, 6 months. So the market, again, as I was saying, I think yesterday, is saying, the economy is doing okay at the moment. The employment situation is robust and stable. So, maybe we want to get cuts, but not just now, maybe another, 3, 6, 9, 12 months further being just pushed out a little bit. So that's kind of very interesting just to keep your eyes on that. And no doubt, of course, if we inflation starts to come down and the economy deteriorates, the employment situation deteriorates, of course, this might reverse. So it's also interesting to see that maybe those cuts will be priced back in more quickly. So we suddenly could see, the market sort of, bidding up, September or December 25 versus selling, September or December 2026. So that's kind of an interesting one there. And you can also just see that if you look at a tick chart here, this is pricing for December 25. And as I was saying, I think the other day, like we had almost 4 cuts. This is the number of cuts by December of this year priced in. And it's just been a relentless grind upwards over the last 2, 3, 4, 5 days. Just based on the fact that, inflation doesn't seem to be going away. The economy is still strong, and, the Fed, very clearly saying that they are in no hurry to cut rates. Now, we've had a bit of stability in the overnight session. And what is interesting today, we have about 5 or 6 Fed speakers. including people such as Barr, Kugler, we have Williams, we also have Waller. Now, as I said, Powell, I think, was a little bit political as well, trying to send a message of independence to the White House. So today, as I say, we have 5 or 6 Fed speakers. So in aggregate, it will be interesting to see if they're a little more balanced, a little less concerned about inflation. And remember that Waller, in a speech, I think about 2 weeks ago, if I remember well, he essentially said that he thought that the tariffs would be inflationary, but it would be a one-time price shock. So he didn't sort of have this idea that, there would be this ongoing sticky inflation. Waller, a couple of weeks ago, basically said that, sure, prices might go up, as, once the inflation rate, the tariff rate was set, but it wouldn't necessarily lead to sort of a longer term sticky inflation, remaining higher and going higher. So he's speaking today. It'd be interesting to see if he comes out with some kind of, sort of slightly different view or nuanced view or more dovish view. That's something to be looking at. Just finally, guys, just want to look here. You see at some of the metals here. You see the gold. I mean, just sort of, came off a little bit, coming up with a slightly weaker US dollar. The hawkishness. What is actually more interesting to me is to look at copper here. Now, for copper, of course, there are a lot of issues here about sort of stockpiles and potential front running of a tariff. So we're seeing that there's, the inventory still continues to build in the COMEX exchange in New York, which is this contract, and it still is going down in the London and the Shanghai sort of warehouses. But what we can see, you see copper here is a little bit indecisive. So on one hand, it's sort of worried about the trade war. On the other hand, there is sort of structural demand for copper and the US dollar is relatively weak. And who knows, maybe there'll be a trade deal. So copper, just at the moment, not a lot to do, I'd say, from a trading perspective, but that's just something I'm looking out for. Other thing as well, I just want to keep an eye here just on the bonds. We can see over in Europe, if we look at something like the European bonds here, they're sort of a little bit weak here, sort of the 10-year German bond sort of just going down. And maybe that's just, because of the so-called sort of deal with the with the UK yesterday. And also the sense that, the German economy, now that they have a sort of a functioning government, they might start to spend some of that money and the issuance will not go away. So the German yields up and the Bund down a little bit. Similar kind of situation. Yesterday, we had all across the US, all of the bonds, there's the 10-year down, but now coming into some pretty serious support here, as you see, the 100 and the 200 days. So that's a very key level here, which we're getting to in the 10-year, around about 110.22. So I'm imagining that will probably hold. And that could be a path dependent, again, what happens on the weekend in China. Just finally, we saw that the VIX actually is sort of, pretty low levels here. So it's a good moment to be sort of putting on sort of long protection, long gamma, long puts, long calls, anything which is kind of long gamma is, relatively good value down at these levels here. And you can see here that the S&P 500 just being sort of chopped around, again, finding it difficult to push above this 100-day moving average here, this orange line, also finding it difficult to push above these key levels of, kind of 57.50. Which is when Trump announced the tariffs, and still the market is a little skeptical. Earnings were reasonable, the sort of a deal, quote unquote, with the United Kingdom, but the market is still very nervous that ultimately the base level of tariffs will be higher, and there's just a lot of uncertainty still, a lot of uncertainty. And everything I'm reading, or the research, is that one of the bigger issues, the uncertainty drag, is really even going to be a bigger issue than the tariff drag, because no one can do capex, no one can invest, no one can invest in machinery or open factories or employ people. So a lot of concern. We'll see today what happens, but probably I wouldn't surprise me if this trades in a relatively tight range today. Again, awaiting sort of information on the talks in Switzerland over the weekend. Of course, there's not any significant data coming out of the US today. Okay, guys, so I'm going to leave it there. Have a good day, and we'll continue the conversation, no doubt, next week. Thank you.